All right, welcome back to another episode where we're going to review what happened to mortgage-backed securities the week prior. So we're going to go back for this week. So this is Friday, Thursday, Wednesday, Tuesday, and Monday. Monday is this big ugly red bar that broke down below this floor. And this, ladies and gentlemen, is a massive, massive move that impacts the market. So as you can see, we have now gotten into a new 2-year low, and that is creating, well, a lot of uncertainty because we really don't know what's going to happen. And the reason for that is because if you actually look at this, from a technical standpoint, there's no bottom. Like there's no floor. So the only floor is created by a new low. So right now, some of these Fibonacci numbers that we have created are based upon this new low where it came down and tested. This was the lowest point that it got, and it looked as if it was just going to free fall. And that's the problem is that, when you look at some of these previous points, these are points of support. In other words, it takes quite a bit to break through that, and then the market reacts to it. Okay, well, once you break through that level of support, especially a long-standing support, when you have, from last October, it's significant. And really all it comes down to is what's going to happen in the fundamentals. What's going to happen in the news? What is the Fed thinking? What are the different economic indicators and what's happening in the world? And there's so many pieces that go into this, and we really enter a world of unknown. Based upon how this is built with the new Fibonacci's, it went up to test this first Fibonacci line. If it does manage to break that and stay above, usually a 61.8 is a good move to it, but these are all technical analysis. And right now, I think the market is more impacted by what's going on fundamentally than it is technical. And the reason that it broke down here is because we still have the Fed just being hawkish, saying, hey, we still need to do some additional rate hikes, this year. And it really knocks out any incentive or hope for, lower rates. So it's going to hang around in a range, or this could just show people, the investors are fed up and like, well, shoot, I'm going to, these are all just investments, right? They're just investors. So they're going to sell, so we drop. And now we're in kind of a world of hurt. Now, this was a really good recovery. And then you can see the candle wick went all the way up here yesterday. So it looked as if it was going to test this point of resistance, and it just didn't. And then we lost all the gains for the day. Half the day it was looking incredibly hopeful, saying, okay, hey, maybe we hit a bottom, we're going to bounce, but we have all this resistance. And then we go through the moving averages, right? So this is still a trend, and trends are difficult to break. So in order to break above this, we're going to have some significant changes in the economy. So yeah, this is worrisome. And what this really is saying is more along the long term, investors are thinking that rates are going to remain higher, at least for mortgage-backed securities. So that being said, anything can happen. I mean, it could bust above this, and this is why we do this every single week. But this means that we're solidly in the sevens and sometimes eights. We're seeing 8% interest rates right now, depending on what's going on. And this is just market wide, right? And it depends on the loan product and everything else. So I mean, you're seeing a wide band, but sixes are really not happening anymore. It's really somewhere between the sevens and eights, depending on credit scores, loan products, etc. So something to keep in mind, something to know for clients, something to know to let people say, hey, this is kind of where the market is. People still need to buy houses, and they need to buy it now, because the longer it takes, who knows what could happen. And then the opposite to this is, if they buy now and rates get better, you can always refinance. But here's where people are really screwing up, is they're thinking, I'm going to wait until rates get better. And when they do, everybody else that's been waiting for rates to get better are going to jump in too. So you might have a better interest rate, but then you're going to have a feeding frenzy on the houses, and that is going to cause housing prices to go higher and higher. So you're going to lose any advantage that you gained, by waiting for a lower interest rate. So the general consensus from a mathematical standpoint is purchase now, even though it's a higher interest rate, and then refinance when the rates get better, because you're going to have a lower house price, and then you can lower your interest rate. Just a thought. All right, and that wraps up this week's mortgage-backed security review. You have a wonderful weekend.